Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 343 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including common dividend mistakes, historical stock market performance after huge oil shocks, potential buying opportunities, performance of stocks during year 4 of bull markets, and a mega backdoor Roth strategy. Whether you're tuning in for market insights, planning tips, or just staying informed, there is something here for you. Aaron, good morning, and thank you for joining us again today. And
happy to be here.
Filling in for Matt.
Always good to do it.
Yeah. So as always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from YCharts and as of the market close on March 25th. S&P 500 index down 4.2% for the month of March and down 3.7% on the year. Dow Jones Industrial Average down 5.2% for the month and down 3.4% for the year. The NASDAQ Composite Index down 3.3% for the month and down 5.6% for the year. The Russell 2000 Small Cap Index down 3.7% for the month, but still positive 2.3% for the year. And the All World X United States Index Fund continues to lag in March, down 8.1% for the month, but up 2.2% for the year. 3-month Treasury rate at 3.73%, the 2-year at 3.84%, and the 10-year Treasury at 4.33%. So obviously continue to be an elevated volatility environment, I would say, Aaron.
Yeah,
and,
definitely.
And some selling and yo-yoing back and forth. We've had some big down days. We've also had some big up days, and that's kind of the market action you would expect when the VIX or the volatility index is as elevated as it has been.
Absolutely.
I was talking with a client last night during a review meeting, and they asked me what my thoughts were about what was going on geopolitically. And one of the things that I always tell people during times like this is I say, I'm not going to sit here and lie to you and tell you exactly when this whole thing is going to end in the Middle East.
Right?
And if there's people out there telling you, they're lying through their teeth straight to your face. So, it's just one of those things that it's really hard to predict when it's going to be over. I think when this whole thing started, people thought it was going to be pretty quick, and it's dragged on longer than some expected. But it's one of those things that I explained last night when I was talking to these clients. It's like, hey, on average, every year we get a pullback of around 10%, at least once per year, right? Now, the news headline is always different for, why the markets are pulling back. But on average, we usually get one of these a year. So this is not out of historical norms, right?
Well, even looking at last year, we had almost a 20% sell-off, right? And the market did phenomenal by year end. So
the news headline, is always going to be different, but the market action usually isn't. So just wanted to throw that out there.
Yeah, no, great topic.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today.
First thing I had was an article from David Harrell on Morningstar titled, "Don't Fall for This Common Dividend Mistake When Investing for Retirement." So this was back on October 30th of 2025. And I think this is a really important topic, Aaron, because at least with my role at the firm, we talk to clients about, what our strategies are, how we're investing their money. And probably the most popular topic is, questions about dividend investing. And it's like, how much income is my portfolio turning off? And if you're not depending on dividend income for spending in retirement, then I think
exactly,
you really need to consider just investing for dividend income only, because as we talked about several times on the show before, yeah, you could have a stock that has a 3 or 4% dividend, but if this price is down 20% on the year, then you're net negative,
you're
right?
negative a lot, right?
So, and it's easy to be fooled, I think, by high dividend yields, which David kind of gets into here in this article. So I just want to read a couple of nuggets from here. So he says, many investors compartmentalize and engage in mental accounting. One prime example of this is the tendency to think about dividends and yield in isolation without considering total return or capital losses. Dividend payments by themselves don't increase your net worth, but there are multiple reasons why some investors might prefer an equity portfolio that yields more than the overall market. For investors in or near retirement, securities with yields that approach double digits can be especially seductive, as they can dramatically increase spendable income or reduce the size of portfolio needs to reach a level of income. Stretching for yield certainly isn't a new phenomenon. Investors have been warned for decades about avoiding dividend traps. There are securities that generate above average yields without sacrificing total return. The Schwab U.S. Dividend Equity ETF, ticker symbol SCHD, for example, which tracks the Dow Jones U.S. Dividend 100 Index, generates a high yield approaching 4%. However, the relatively recent emergence of, quote, covered call exchange traded funds, end quote, with amplified yields has changed the landscape. Funds such as JP Morgan Equity Premium ETF, JEPI, and JP Morgan NASDAQ Equity Premium Income ETF, JEPQ, trounce the yields of traditional dividend funds. JEPI owns stocks from the S&P 500 while systematically selling 1-month calls on the index, while JEPQ does the same thing for the NASDAQ 100 index. JEPI's 12-month trailing yield stands at 8.4%, and JEPQ reaches double digits at 10.6%. And that's the thing. People see that,
that's
Aaron,
not really
and they're
a
like,
dividend, though, right?
It's
it's a covered call strategy.
Exactly. So, but when people see dividend yield
really
of 10.6%, they're like, hey, I want to own that, right? But as always, especially in our industry, Aaron, I always go by the saying of, if it sounds too good to be true,
it probably is.
If it looks like a duck and quacks like a duck, it's probably a duck. So he continues and says, but there's a trade-off for those yields. You're earning that income from the option premium, but the option essentially is adding a cap on the underlying asset and how high it can grow. And because of that cap, the total return on your covered call ETF is more than likely not going to outperform the underlying asset. By selling that covered call, you're giving someone else the right to buy that security from you at a predetermined price in the future. So if that person exercises that right, Aaron, the upside return cap comes into play, and that limits your total return, right? Jenna will throw some of these charts up on the YouTube video. They'll also be in our show notes, but it just shows the performance, I think, since 2020 of JEPI versus the S&P 500 and JEPQ versus the QQQ, which is the NASDAQ 100 ETF. And quite clearly, you can see on a total return basis, they significantly lag. Now, I'm not saying this isn't a right fit in certain portfolios, because
it could make sense for like an income or fixed income replacement or something like that, right?
It can.
But it's, it's done half of what that SPY has done. So,
But if you have, if you're, just investing in mutual funds or ETFs and you have the majority of it in like a VOO or a SPY, I don't think it's a situation where you should be like, oh, let me just sell all of that and put it all into a JEPI or JEPQ or something similar.
You're just, from my perception, it looks like you're giving up, say the S&P 500 was up 20. Well, you might do 10, right?
Yeah.
So you're giving up a lot of potential growth just for that kind of income, which I don't know.
Right. And just because, on JEPQ, the yield right now is 10.6% doesn't mean it's always going to stay there, right?
No, there's no guarantees.
the option premium and how these ETFs generate yield is based on volatility. So when volatility is higher and you're selling options, you get more of a premium. So I would imagine, I haven't looked, Aaron.
These are probably attractive right now.
They're probably very attractive. The yields look probably really juicy because that option premium is higher. But when we get into an environment where the VIX is lower than 20, you're not getting as much for those options that you're selling. So that yield is going to come in. So just important to really understand the mechanisms behind how these things work before you just jump, head first into it.
No, I think that was great. That's perfect.
Second thing I had was a chart from Taylor Schulte's newsletter that shows historically what happens to the S&P 500 after huge oil price surges. Jenna will throw this up on the YouTube video. It'll be in our show notes. So again, this chart shows the S&P 500 1-year forward return following 2-day oil price surges of 20+%. So the average return in past instances have been 24%, which might be a little shocking to some people because I think, people think of oil price shocks, they think of market volatility, market weakness. And yes, I think that's true in the short term, but when you go over a year time horizon, returns look a lot better. So
interesting. That's surprising to me, honestly.
Yeah, and I think the biggest one is March 31st of 2020, not that long ago, had huge oil price surges, and 12 months later, S&P 500 is up 53.7%, which is kind of crazy. So there's only been one instance actually where you've had a 2-day oil surge of 20% or more, and then a year later stocks be actually negative. So not a huge sample size, but I think, again, it just goes back to what we've talked about over the past couple of weeks is, yes, there's going to be short-term volatility and short-term noise, but when you look past that and you expand the time horizon, things tend to look a lot better.
Absolutely. They get priced in quick.
Last but not least, our good friend Ryan Dietrich had a post on X on March 20th. So he said that the S&P 500 is in the midst of its first 5% mild correction since November. We tend to see 3 of these per year on average. They aren't fun, but they are necessary to investing. So again, kind of similar to what I was talking about earlier with, on average, once per year, we get at least a 10% correction. We also get at least 5% corrections on average, when we're going back to the early 1920s and looking at this data. So nothing, at least to this point, out of the ordinary. Again, the reason for all of these pullbacks are going to be different, but nonetheless, this is very normal up until this point.
Again, I like his point. It's not fun, but it's just how it goes.
Right. It's part of investing.
You give that volatility to get better returns, right?
Right. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
Awesome. Anything else before I jump into mine?
No, go for it.
All right. First thing, I found this post by Justin Banks. I don't know him. I just saw his info, his post here, and I thought it was pretty interesting. It's a chart of SPY, and he said, basically the best buying opportunities over the last 10 years all came from the same spot, the retest of the previous bull market high, 2020, 2022, 2025. He said now it's at 611 That's the price on SPY. And he says, don't believe me, just look at the weekly SPY. So I think that's really interesting. It's pretty solid data in my opinion. So yeah, that's typically, I would say this is the 2 steps forward, 1 step back motion in the market, right? So again, it kind of goes hand in hand with Ryan Dietrich's post there, is that, that's the part of investing. It's going to push forward, and then we're going to have some pullbacks. But I would look at these moves, these geopolitical events as buying opportunities if your timeline's long enough. So in my opinion, not a reason to panic or get out of the market. It's just a reason to keep doing what you're doing.
Right. Yeah. And this chart is music to my ears, and I'm glad that you picked this.
I know you like these technicals.
I love technicals. I love looking at charts because it just gives me the information without the noise. Right.
Absolutely.
And if you're just listening, what this is showing is that, after markets have broken out to new all-time highs, they tend to pull back to those breakout levels, right? And we've seen that over the past several years. And, those breakout levels, what I refer to as, support and resistance levels, where there's a lot of buyers or a lot of sellers at certain levels. It tends to check out over the long term, and we've seen a lot of these really nice buying opportunities at previous all-time highs in the past. So and typically when price gets to those levels, it really feels like bad. If you're buying,
you
you're
look
like,
at the fear and
I
greed
feel like
index.
I'm doing something wrong. Like, this does not feel right. And again, typically that's a great time to buy.
Well, and obviously no one can time the bottom perfectly unless you get lucky, but it's good data point. I like it.
Sure.
Next topic, I got one from Ryan Dietrich as well, our friend there. This is a X post on March 24th, and it's a data point for bull market run. So he says this bull market is in year 4, which is historically quite strong. Assuming the bull market doesn't end, by definition, a 20% decline, you can see this year tends to be pretty strong. So, and he's got a chart here from Carson Investment Research, and it shows the average performance on year 4 of a bull market is 14.6% up, and the median is 13.7% up. So other than year 1 and 2, it looks pretty good in my opinion. Again, just a data point, no guarantees, but also doesn't mean it's going to be smooth getting there either, right?
Yeah,
So
yeah, and I want to remind people too, we've beaten it to death, it feels like, that, coming into this year, to midterm election year, we expected weakness and volatility.
absolutely.
That doesn't mean that the year has to finish negative, right?
Yeah.
So
volatility doesn't mean it's going to be bad.
No, and specifically, most of that weakness comes within the first 3 quarters, and then Q4 of the midterm year tends to be really strong. So it's not out of the question that this year could still be an average year, or heck, even a double digits return year, right? But it's just, we knew at some point there was going to be volatility, and the road to get there was bumpy.
It's probably going to be a lumpy year where performance comes in big chunks, and down in big chunks as well.
Yeah.
So we'll see. I think that's some reassuring data
For sure.
All right, I got one more for you.
Okay.
This is there's some hot takes in this. I'm gonna say that. I love Ben Carlson.
Like I'm talking to Jessup.
I know. This is X post on 325, and it's just him commenting on what he feels is priced into the market versus what is not. So I'm going to run through all these, and you can tell me if these are hot takes or not.
Okay.
First, he says war equals priced in.
I would tend to agree with that.
Oil price spike priced in.
Agreed.
I also agree. Higher inflation priced in.
Yeah.
I'm going to say maybe.
Yeah. I don't know. Well, I mean, it's like, what's the definition of higher inflation at this point? Because it's sitting at,
inflation's always going higher, right?
2.1% or something. So
yeah, I'll be curious to see when the next CPI. I don't remember when the next data comes out. It'll probably be a couple months.
Yeah, it might. Well, so we're at March 26th, so it might be next week. Next week or the week after. So
excellent.
Probably the week after.
So most of that's not going to be. We're not going to have data on oil yet because it comes at a 6-month lag, unfortunately. But next one is ceasefire equals not priced in.
starting
kind of
to
agree.
possibly this
Yeah,
week. Maybe.
I know this is like a day stale now, so maybe.
Right. It's just weird because like yesterday you had the administration came out and said, hey, we're talking to Iran and they want to get a deal done. And then I also read a report that Iran was doesn't want it. And then stocks were up. So it was like, who knows what do you believe? Yeah.
Right. Says no ceasefire priced in. I would agree with that.
Yeah.
Fed rate hike probably priced in. I don't know about that one. I think that one's not priced in my opinion.
Yeah, I don't.
Again, it comes down to what inflation does, but
right,
I'd be very surprised if the Fed hikes this year.
Yeah, I would too. And it's just, again, after what we saw last year, it's like kind of hard to like believe any of this stuff, right? It's like in April of last year when the tariff situation happened, I think every logical thinking person was like, this might lead to inflation, right? With higher prices. And it didn't, right?
Yeah.
And we actually, we got Fed rate cuts last year. So it's like the opposite happened of what every expert or so-called economist had predicted. So I think it's just a waste of people's breath, spending their time trying to predict what's going to happen.
Oh yeah, no one can guess.
Yeah, a couple of hot takes there. I mean,
I thought it was interesting.
I think the because of what's going on in the Middle East right now, the chances of the Fed continuing to cut those odds and probabilities have decreased.
If they cut, it's probably going to be much later in the year.
Yeah, I would imagine so. Interesting. We're always trying to figure out what the market has priced in and what it hasn't. And we just have to remember and be cognizant that the market's looking 6 to 12 months ahead and not really taking into consideration what's happening now.
Absolutely.
So
awesome.
Well, I am going to leave it there for myself, Aaron. I'm going to let you hang in here with Taylor to talk about the financial planning topic of the week. I think you can probably provide a lot more insights into this topic than I can.
Sounds good.
Just a reminder, the end of the quarter already is next week. So just in a couple weeks' time, we're going to get the banks reporting earnings again, which feels like it just happened.
Years are flying by.
Flew by. So obviously we'll be on the lookout for that and provide updates. But until then, I will leave you with Taylor.
Thanks, Mark. Hey, Taylor.
Hey. So today I'm going to be talking about a strategy called the Mega Backdoor Roth strategy.
It's a good one. That's cool.
Yeah. As we go through it, you'll have to let me know if you've seen this with any plans.
In practice, yeah. We'll talk about it for sure.
So I'm going to be referencing an article from Plan Corp. And this article breaks down this strategy basically into 3 different segments. So the first segment, just talking about annual contributions. This is going to really focus on high income earners who are maxing out 401ks already. So just to review contribution limits first. So for this year, for 401ks, the annual limit is $24,500. If you are above age 50, you can do an extra $8,000 as a catch-up. And then something that is a little newer is if you're between ages 60 and 63, you are allowed a super catch-up.
I love that. Yeah, I think that's a great thing that came out of some tax changes and regulatory items. Not fun for record keepers and TPAs. It's another wrinkle to their calculations, but no, that's a cool thing that's added for people, getting really close to retirement.
Yeah, I agree. And something else I want to add is that there was an update starting this year that if, again, you are 50 and older and you're doing those catch-up contributions, if your income was more than $150,000 in the previous year, those catch-up contributions now have to be Roth.
Interesting. Yeah, that's I've seen some plans have to add a Roth option to their plan to account for this. So lots of changes going on here. So
Yeah, I think legally, if plans have not had the Roth 401k option in the past, they have to adopt that by December 31st.
Interesting. Okay,
By
cool.
the end of this
That would
year.
make sense.
So, where this mega backdoor Roth strategy comes in is that some companies also allow what's called an after tax contribution. So I think most people are familiar with your traditional pre-tax contribution, your Roth contribution, but an after-tax contribution is kind of a blend.
Yeah, it's kind of
of the
weird.
two.
It's kind of weird if people haven't seen it. It's I like the way you said a blend. That makes a lot of sense because you put your money in, you're not getting a tax break now by saving it, right? But as that money grows, it grows tax deferred, right? So that's the
Correct.
advantage is the tax deferment until you take it out.
Yeah. Basically, like what you just said, the contributions, no tax break, but everything else, the earnings are going to be taxable when you withdraw in retirement. So those are kind of the three different tax buckets. Now, the next part of this article kind of gets into making those after-tax contributions and then tying it into this Roth strategy. So I mentioned the annual limits for employees, but between employee and employer, you can actually put up to 72 grand per year. And again, if you're above age 50, it's about 80 grand for that regular catch up. So let's say that your company does allow those after-tax contributions. Let's say you're 50 and older. You do the max, you do the catch up, which totals about $32,500. Let's say your employer matches about 5 grand. That means if your company does allow these after-tax contributions, you could put in up to $42,500.
It's quite a lot.
Yeah, so definitely something you'd want to check with your plan administrator about.
Absolutely. Yes. And I've seen it's not super common to where I see after tax contributions are always there. Normally it's bigger plans that, can handle the administrative complexities of 3 different kind of sources of contributions. But I have seen a few clients and friends that have done this strategy and it's really awesome if you're, in a financial situation to be able to do it.
Yeah, I was doing some extra research outside of this article on like how many plans actually offer this. And the number that I was seeing was about 20% of
Sounds
all
right.
401k.
Sounds right to me.
So regarding the Roth conversion strategy, some plans allow you to do an in-house conversion inside your 401k. So you can basically, again, do those after-tax contributions, get closer to that 72 grand limit, and then convert those after-tax funds into your Roth 401k at work. Some plans may automate this conversion, not all. So again, that's something you would have to check with your plan administrator about. So I think that's a really great option for people who are already maxing out
Absolutely.
their account.
Yeah. So if you're a higher earner and obviously can afford to set aside that amount of sum, it is great. And typically when we see higher earners, they can't really make a traditional IRA contribution, or there's not a lot of tax advantages, or they can't make a traditional, a Roth contribution without doing some sort of conversion or backdoor strategy. So for higher earners and, people that are trying to save as much as they can in a smart, strategic way, I think it is an awesome, awesome strategy. It's a big loophole, honestly.
It is.
So it's, for higher earners, it's a wonderful strategy to have a lot of tax-free money come retirement time, right? Because if you're just doing a Roth IRA contribution, it's $7,000 to $8,000 a year, right? So being able to do up to, basically 80,000 if you're at your, latter earning years, is huge to have that tax-free in retirement. So I think it's an awesome strategy. I wish more plans offered it. I understand why they don't, but excellent topic there.
Yeah, and to kind of add on to what you just said, with the traditional and Roth contributions, there's a phase out range for income.
Exactly.
So that's why you said a lot of people might not be able to take advantage of that.
Exactly. Yep. Perfect. Anything else on this topic? I think it's a wonderful one. So, people that have a 401k plan, that, kind of do some research, see if you have these different sources of contribution options. Again, not all of them do, but if you do, make sure you're taking advantage of it if you're in a financial situation to be able to. I think it's an awesome strategy.
Yeah, absolutely.
Perfect. I think that's all we've got today. Jenna, thank you. Anything else you have last minute, or I think we're good to sign off?
Yep, I think we're all good.
Perfect. Thank you for listening to episode 343 of the Independent Advisors Podcast. Catch us next week for episode 344.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.